We have now hit the noon hour in the Eastern Time Zone, 11 here in Chicago. And as promised, we're going to do a little Fed FOMC preview for everyone out there. And that means we're going to bring in event trader Gavin McGuire and chart trader Brett Manning. Good morning, gentlemen.
Good morning.
Morning, Jim.
So,
how's it going, Brett?
Doing pretty good, Gav.
That's good. That's good.
So, Brett, we've got a pretty robust move here in the indexes. S&P futures up 22 points. This is a pretty strong move heading into the FOMC. Don't typically see these type of moves.
No, unless the market is pretty convinced it's going to get some good news.
And so, with that said, what's your takeaway? Do you think we're going to get some good news?
You know, I'm not really sure. I assume that we are going to hear reaffirmation of things that we heard at the central bankers panel, which would be an upside catalyst, and probably the market is front-running that. I also think that it's interesting that, as I talked about in my notes this morning, it's almost like the Fed pulled a strategy out of the basket, of the ECB basket, last week with that Wall Street Journal article that came out and kind of hinted at basically less aggressive process with a nearer endpoint in terms of balance sheet shifting, and how the market reacted to that was, pretty dramatic. And I wonder if that was kind of a trial balloon to see whether or not that can essentially function as another policy tool, forward guidance on the balance sheet reduction. So it seems to be something that's really triggered some responses in the market, and we may see them make use of that today.
All right, so what do you think? Let's say we drift higher. What I almost wonder is if we're not setting up for a potential fade here. We get some of that policy talk that we get, and then it becomes a very cliche sell the news type thing. But when we do see a move like this historically over the course of my trading career, and of course this isn't tested, this is more anecdotal than anything. However, what I have seen is the market set up for a type of fade. That's what I would actually be looking for coming out of the Q&A.
Yeah, last week I said I was looking for a move to 2690 to 2710 as kind of what I call the capper on this rally, and that would make a lot of sense to me. It may be something that sustains itself following the meeting for a day or so, and gets up into that zone, and then starts to slip, and really people start to feel like, well, what's the next positive catalyst? What's out there? Mm-hmm. Although I suppose that, as we talked about yesterday, it's not crazy to think that the process with the China trade war is a little bit vulnerable now to spitting up some good news rather than the tough rhetoric, whether that's an extension in the deadline or a reduction in what the U.S.'s demands are, just to get some kind of win going. That's not impossible that the market is concerning itself with that a bit right now. But yeah, I've really kind of been looking for 2690 to 2710 as a zone to start looking for some fade, and I would like to see it be an emotional move from here to there, something that's really pretty dramatic and really kind of gives that sense of almost an upside capitulation. And if it's driven by some news, especially out of the Fed, that would make it relatively interesting to start fading.
All right, I'm going to bring Gavin into the conversation because, Gavin, you lay out a lot of different scenarios, and let's pretend for a second that we can get that move up to those levels that Brett was just talking about. What do you think would be the catalyst that would drive that?
I think kind of what Brett was laying out, a little bit more dovish Fed and an upbeat tone around trade talks would certainly be enough to send any shorts that are around here to the sidelines, and probably be enough to entice people off the sidelines as well. A little bit of that FOMO trade going on. A lot of people have been looking for that pullback to 2600, and at this point, if we get a breakout and then we get that fundamental catalyst, at least on the sentiment side, we'd certainly see people piling in. Certainly the earnings reports that we've been getting have not really been blowing anybody's minds in terms of how strong they are in terms of great guidance. The common term that we've seen is better than feared. So I don't see earnings really coming in to pull back in sentiment at this point. So right now I think it's all about the development of what happens over the next 2 days. I just think that people might be leaning off sides a little bit here what they're expecting from both the Fed and these China trade talks.
I'm curious. How much do you think the Fed will talk about what might be going on, considering that we've got trade talks going on? How much color do they actually provide?
On the trade front, are you asking?
Yeah.
I think the Fed would look to try to stay out of that lane.
Oh, okay. I just based on what you just said, I thought maybe they would provide some commentary.
I'm talking about the backdrop of the China-U.S. trade talks as well. I thought we're talking about both macros there. I wouldn't expect the Fed to try to go too far into that water. We've seen past comments where they've said that tariffs aren't having as much of an impact as they had thought they would. That's been in the commentary over the last couple of weeks. If you take a look at Powell's comments from the Economic Club, he had mentioned as such that tariffs weren't having a major impact on the economic outlook. But his exact line was tariffs on either side have not had much impact on economic growth. But of course, there's a worry about a further decay in those talks. So outside of that, I really wouldn't expect him to venture too far into that lane. He doesn't want to disrupt anything, especially with the two groups meeting. So I think for his press conference, he's going to want to keep it to the economic commentary and to the balance sheet at most. So I wouldn't expect him to delve too far into the trade aspect of things.
All right. And what would you say would be the key risk that would just send the market lower right off the bat and just continue going?
The key risk, if he continues to talk up about how strong the economy has been, I sent you that Citigroup Economic Surprise Indicator chart. I don't know if you want to pop that up onto the page, but as you can see, we're kind of right in the middle of the line, and I think a lot of people are expecting more of a fall off in this at the moment here. We had a bit of a dip, but that's come back as of January 29, and it's right around even. So the data's coming in right in line with expectations. And if you start extrapolating from that, Brett, I don't know if you'd have an opinion on this. The baseline scenario for the Fed is 2 rate hikes in 2019. And, I mean, just taking a look at, like, say, for instance, the jobs number from from January 4, where it blew away expectations. Now, we could see some comments about not getting as much of the data as they would have liked because of the government shutdown, and that could be a little bit of a treasure trove of information thrown the market's way that could help tilt this economic surprise in either direction. But, I mean, if you're taking the Fed at their word, and right now their outlooks for 2 rate hikes in 2019, and that Powell continues to talk up of a strong economy and data coming in line, I think that the outlook for the markets should tend a little bit more towards those 2 rate hikes in 2019. And if that's the case, then perhaps it's not as dovish as some had hoped. And that's kind of where I see some of the risk coming in for the Fed meeting. Brett, I don't know if you got an opinion on that.
Well, I mean, I would say if you look at it as, let's say we take them at their word, there's going to be 2 rate hikes this year. I'm a little skeptical of that,
Right.
but if there is, it's not going to be in the first half of the year. Let's assume that. So
Correct.
they don't need to work right now to try to change expectations for fear of rolling the markets with a hike in March. Right? That's not going to be on their docket of tasks to accomplish today. So I think it's probably pretty unlikely that they've got to feel like they've got to prepare the market for more hawkish action over the very near term. Eventually, if they want to do those hikes, they're going to have to do that. But they probably don't need to do that this meeting. So I think I don't know what the market's really expecting, though.
It seems to me the market's expecting them to take March off the table as a rate hike.
March is off the table, as far
Yeah.
as I'm concerned. Like,
I agree
Fed
with
fund
you. I mean,
futures are like 100% to no change. They would have a ton of work to do, and they'd have to start right away to get March back on the table.
Right, and I agree with you. And I mean, we've talked, we were talking a couple months ago when they were looking for 3 rate hikes that we both thought a rate hike was more likely than 3 rate hikes at the time. And
Right.
yeah, exactly. I just I just think that people are looking for a very dovish Powell to come out. I don't think that's going to be the message. I do think that their number one goal at this is to take the March rate hike off the table. And as Brett said, looking at Fed funds futures, I think it kind of is off the table. So I don't think that they have to really go that far.
They don't need to lift a finger. Yeah, the market is assuming no hike coming down. They'd have to really work hard to prepare the market if they were still planning to go forward with a hike. So the burden is on the opposite direction. I think he could sit there and say nothing, just stare at the camera for a half hour. I do what he needs to do.
Just wink and wave his hands through that hair.
Yeah, exactly.
I think the key line with that in mind, Brett, is this: the committee judges that some gradual increases in the target range for the Fed rate will be consistent with sustained expansion of economic activity. I think if you see any move away from that, and I think that they, given how much they've said it with all the members, they need to put in patient or prudent to pause, or something along those lines, in order.
Yep, super data dependent, and right now the risks are balanced or something.
Right, because you just look at, like I said, that's Citigroup Economic Surprise Index. That's right at that zero line. It's been pretty even here, which means that the Fed outlook's kind of running in line here. But in order to get March off, I think some sort of patient or prudent pause language needs to be in the statement. And if it's not, then
maybe that's exactly what the market's front running then. If that sounds reasonable what you're saying.
Yeah.
And if that's the case, then they'd need to insert some language to officially pause. Maybe that's what the market is front running right now.
In which case, I think if it is in there, that we get that pop into that 2,700, that could be that fade that you're talking about, Brett.
Yeah, and if that's paired up with, some tweets over the next 48 hours that essentially suggest... they're not coming yet, though, right? What I'm seeing most likely from the China situation is that things are going well enough to justify moving the March 1st deadline back.
I would agree with that.
Yeah, I think that's starting to become the expectation, and that plays right into my theory about what China's plan is. Do that as many times as you can and wait for a new administration to be elected.
See, I was talking with Jim about this. I do think that you're wrong on the idea that a new administration would change the tone. Trudeau is arguing, because look at how Canada is handling the situation with China, with the arrest of the Huawei rep and kicking Huawei out of their business. We've seen from Germany, we've seen from Australia, all these with liberal, progressive leaders. I think this is more of a global move. I think the Trump administration certainly kicked it off, but I think this is something that finds support across both aisles, which is, as we know, extremely rare. And I think China's starting to figure that out, that perhaps they could perhaps even maybe think that they could get a better deal with the Trump, which it sounds crazy with Navarro.
I think the tariffs are not. I think the tariffs are not in line with what you're saying. I think the idea that China needs to make some shift in terms of its foreign policy and finding a strategy to bring that about, I think is probably something that will be with us for a long time. But I think the sort of extremely tough negotiating, willing to do big tariffs. Look at what else he's done. He ditched NAFTA. He's done all these things. This White House is particularly protectionist.
They are. I'm not going to argue that, but I do think that China is finding kickback from a number of different countries, and perhaps not on the level as the U.S. But I think that it would be a miscalculation on their part if they think that say Biden or Beto or O'Rourke come in, for argument's sake, that they would be able to get off any easier. And I think that they're starting to realize that with some of the kickback that they're seeing. Trudeau, you would have to say, is one of the more progressive leaders out there, and Canada's been kicking back plenty. And they rely on China exports. With their crude oil and everything, probably more so than the U.S. does, but they're still kicking back on the IP. So I think that they're starting to see that their One Belt, One Road initiatives and their China 2025 initiatives are kind of roiling global markets, and they're seeing more of a broad-based kickback that I think that that I don't think that they could wait out the Trump administration as much is the feeling that I get when I see things unwind here.
Okay, well, we'll get to find out.
Yeah, we're getting a little closer to that.
Well, it makes a market, yeah.
It's exactly what makes a market. But I guess how it rolls out to is how these trade talks unfold, and I think we're still at the early part of the process, and I just think that both sides are going to want to strike a positive tone as it behooves both of them. Trump needing a win, as Brett said, and China not really looking for a lot of volatility ahead of their Chinese New Year week.
Yeah, well, but to tie a little bow on it, probably that announcement of a delay in the deadline and the notion that there's big progress happening or something probably doesn't come this week, right? I mean, they've got one more round of talks to do that. So that little afterburner jet on top of this rally with them, moving back that, because that moving back that deadline is going to be a very direct, positive, economic bull item. Right.
Yeah.
So,
and again, I guess it goes into both of it, right, Brett? I mean, we're looking at a pretty dovish expectations around the Fed and pretty bullish expectations around these trade meetings, and I just don't know if either one's sustainable. Right here now, I'm not looking to short in front of those headlines either, though.
Right. Yeah, and then there's, I guess, the shutdown is also kind of on people's minds, and that doesn't look like that's going to resolve itself very easily.
No, not at all, especially now that we're going to have the debt ceiling sprinkled into there.
Unbelievable, yeah, right.
And I was fascinated to see the comments from Lawrence Summers just a little while ago. Did either of you guys?
I did not.
He was talking about, obviously as a firm Democrat, he was talking about the need to expand debt and that it was more important to do that right now, which I thought was amazing considering you would think he would have a little bit of a partisan take on the matter. And he also kind of kicked back against the progressive tax that Elizabeth Warren has been putting forward too. It's a fascinating comment. I'm sure if you popped onto the CNBC website, you could catch a replay of it. But it's just really interesting to see that coming from, a pretty substantial Democrat who's got the ears of a lot of Democrats. Now, whether or not
but not a populist.
Not a populist. No, not a populist at all. But it was interesting to see him think that it was more important to expand the debt right now rather than try to rein it in order to build infrastructure projects and stuff. It just nearly knocked me over with a feather. And then he was also kind of against the progressive income tax because he was talking about how European countries had put it in and they have all rolled back that progressive income tax. I just was really surprising commentary to me. I thought that could be bullish for the market down the road, but we'll see.
Right.
Well, it looks like it's bullish for the market right now, all things considered.
Animal spirits at work here for sure.
All right, Brett. So when you're looking at the market today, and let's just get back focused on the Fed and the release, you're going to be looking at what first? The equity markets? Are you going to do anything in the bond markets? Anything in gold? I guess how are you going to take the approach if you see something in one thing, or is it all just so interrelated and you're just going to look for the opportunity?
Okay, so we've got a slope line, if you look at an hourly chart of the S&P right now, that you can do off of the highs, the two highs that we've got, where the second one is slightly underneath the first one. Okay, if you can kind of picture that in your mind, or maybe you've got it up on the page.
But that's on the daily you talking, Brett?
If you look at, I look at a 60-minute for this type of pattern. We've got a triangle in the S&P that's been building over the last, couple weeks. And we've got the, I guess the first high was on the 18th, second high was on the 25th. You connect those two highs, you got a sloped line. It's a bull trigger line. So what I want to see is maybe a move to 2670 or so, maybe out of the announcement, and then a pullback back to 2660, 2658, somewhere in there. And if it looks like I see a chasing bid, I will be buying the market for a breakout above 2670, looking for that 2690 to 2710 area. And then I want to turn around and probably start fading that if I see a character to the tape that suggests that we have finally, and especially if I see like a put call down around 0.5 or something tomorrow, and we're up at 2,700, then I think that all kind of fits together as that kind of capper move that really blows out, because you're talking about blowing out all this bearishness that cooked in December. I mean, if you look back at the sentiment data that we saw, you look back at things like the retail only buy to open put call ratio, and you look back at the equity hedging index, and you look at the cumulative 10-day moving average of the overall put call, which is really striking. You look at the VIX futures term structure, all those sorts of things suggest we got to a place in December that was really just historically bearish. And as I've kind of been preaching a little bit for the last month, as you work out of that type of a bottom, the problem is you've got all these people who are really strong hands and long-term investors who got shaken out. That's what that sentiment means. That's what it tells you. There's no way that didn't happen. What that type of sentiment reading means is that when we were at the lows in around Christmas Eve and Christmas Day in the futures, we had people believing that another major crash was about to happen. It's not that was the crash and they were bottom picking. That sentiment indicates that people were protecting or scrambling because they thought that a 1987 style 20% down day was coming the next day. That's what that sentiment suggests. And that also suggests by inference that a lot of people just threw in the towel on their bull cycle positions and their long-term positions. And they must have believed, hey, here comes a big recession, here comes something terrible. Now we're in the process where these pullbacks are really shallow. The market is trapped up against the highs because everybody's competing to buy into those pullbacks. And that type of mentality needs to be drained out of the market. It needs to capitulate out of the market. We need to get rid of that before we've got a fade. And with the VIX where it is, probably there's going to be a really nice fade once we get that out. Once we work that, exercise the demon of that kind of tape out of the system, and a big blow-off pop on some positive news catalysts is precisely the way to do that. So if we get that, it's possible to catch this coming and going. If we get that kind of nifty pullback under that dotted line across that slope, and then we break out and we really kind of exhaust it. We get like you're talking about, that FOMO move where it just has afterburners on it, because people now who have been waiting to buy into a pullback finally just have to hit the button and buy, because they feel like the next thing they're going to see, it's going to be at 3,000, and they're still out. And it's almost fear buying at that point, like fear of missing out, but really turns into almost panic of missing out. If you get that kind of mentality going, you're overshooting, and that's going to set up the fade. And when the fade then gets rolling off of that kind of process, it's going to have some legs to it, and then maybe we'll get back to that 25-60 area. So I think there could be some interesting swings here, and hopefully these catalysts set up to really trigger it.
Brett, you paying attention more to the S&P or the NASDAQ with these moves? Or
you know what I'm doing? I'm keying off the S&P and I'm trading the NASDAQ.
Okay.
I like to do that.
Hey, Gab, I'm just curious, how much will the government shutdown impact the data that the Fed's looking at? For instance,
Good question.
They say that it's data dependent. However, they may not have all the information that they would normally have. Therefore, maybe they could just punt, and that could set up for, we're going to wait till the next one to give a real reading. So I just wonder how much that comes into play.
It certainly comes into play, and I think that gives them the pass to note, due to the shutdown, we've been delayed with some of the data, and that works perfectly into that pause language that we were talking about to take March off the table. They've said repeatedly since the December meeting that they're data dependent, but without that data,
right?
Then it gives them a right to pause, and and then I think that they'll be careful to note too that they expect some transitory impact in the data that they're going to be getting as well. So again, this all leads into that delay around a March move, which I think is the primary goal for this, to take March off, to continue to highlight that the economy is performing well, but that they've hit kind of a comfortable, probably say something along the lines of that they're closer to neutral, and that all plays into the language that we should probably be expecting to hear. And if that comes in, how much of this rally has been priced in around this language, which I think has been a big part of the move ever since Jerome Powell stepped off the dais in his press conference last meeting. Immediately we saw stepping into that gap was New York Fed President John Williams coming in with a much more dovish take. And then we've seen Powell speak twice since then. On January 4th, he spoke at that roundtable with Yellen and Bernanke. And then on January 10th, he spoke at I think it was the DC Economic Club, where he provided a little bit more, not dovish, but just a little reined in from what his last press conference was. So I think all that language and all those expectations have been kind of priced in, and that's where it plays into whether or not we get the fade. How much of that has been priced into the markets at this point, and that's going to be a key read to keep an eye out on, and I'm sure that's what Brett's looking for here too. And then the next step. Shoot, Brett.
Well, I was just going to say, what you outlined, I think it's great, and I think it really, the way that I would title it is, have your cake and eat it too. I mean, it sounds like the panic in the market has put the Fed into a situation where it's much more cautious about becoming hawkish, and yet the economic data hasn't really shown itself to be that bad. So yeah, have your cake and eat it too.
Yeah, and I think the cake and eat it too part comes with the balance sheet, right, where you're talking about that trial balloon.
That would be extra, yeah. Right. But I just mean it's a good economy, and they're scared of being hawkish.
Right. Yeah. No, I'd agree with that, and then the balance sheet is the cherry on top, I guess we could call it, right?
There you go.
Which I still that would definitely be a reversal of language, because the last comments on the balance sheet, and Jim, I don't know if you see that St. Louis Fed chart that I sent you, which is the link to it, which is the current Fed balance sheet. As we can see, it's still holding around that $4 trillion mark. In his last comment, which was January 10th, I think it was, let me just double check that, where he said that there's still a substantial wind down to get it back to normal levels, which would be more in that 2.7 to 3.1 trillion range. So as you can see, that would still be to break through that 2,700 area, Brett. And if we don't get that, but we get all the other stuff, then that's where we get that run up into 2710, and then a fade potentially. So that's what we're looking for.
As far as normal, what they're labeling normal levels on the balance sheet now, it's around 2.5%.
Most of the language that I've seen since the Fed started ramping up the balance sheet, and you can see it there, like, obviously in the midst of the crisis in 2009 is when we started all the bond buying programs and everything. It's just been on a steady ramp up, and the language that I've mostly seen from Fed members, and let's not forget, I think it was at something like, I forget what the exact numbers was, like 800 billion before things really took off, was for normalization to come back around that 2.7 and 3.1 billion area, which is obviously 900 billion away. You do 50 billion a month, you could do the math there. That's still another 2 years of unwinding at the moment. But if we did see that pause and that language reined in a bit, then I think that's the next level of dovishness that the market's kind of hoping for in order to leave monetary policy as a tailwind rather than a headwind.
I'm curious what it was before 2004. Does this chart go back further?
Like I said, I think it was 800 billion before the crisis.
Right. So it's just funny how there is really that
tailwind rather than a headwind.
I'm curious what it was before 2004. Does this chart go back further? I can't make it go back further.
Like I said, I think it was 800 billion before the crisis.
Right. So it's just funny how there is really that new spectrum of what normal is for them now post the financial crisis.
Yeah. I mean that's how things have changed, right? So. I'm not seeing anything before 2004 on this, so not 100% sure what the levels were there, but obviously nowhere near $4 trillion. We could agree with that.
Yeah,
right?
For sure. All right. All right, so we've kind of broken down, laid out some different scenarios, especially in the equities. Is there any other markets that you're going to focus on, bond market at all, chart trader?
Gold is interesting. I mean, if we get into a situation where they surprise and you get that sort of, the thing that nobody's expecting right now, and they are, significantly more hawkish, and they refuse to take March off the table, and they act different about the balance sheet. All is really unlikely, but you get a big shakeout in gold to buy. So maybe that's the asset that I'd buy into in that situation, and you would be focused on shorting equities. But that gold, I said it last week, and yesterday when we talked, I think it's in a bullish trend, and I think there's going to be shakeouts, and they'll probably be related to the Fed when they happen. So, gold.
All right. Anything else from you, Gavin, that we should be highlighting? We're, an hour away from the Fed release, hour and a half?
Yeah, no, we'll do a follow-up as it comes out, and obviously be listening to Pal. I do have a question for Brett, though, on today's move in the yen. I know both Jim and I were a little dumbfounded by it, given the market moves over Japan, too. Usually there's that inverse correlation. Did you see anything in yen today, Brett, that would suggest that that weakening move? Obviously, I mean, you'd think the dollar would have rolled over, but just seeing kind of the euro strengthening, the yen weakening. You got any thoughts on yen?
It doesn't look too dramatic to me, but I suppose that it's just repositioning in front of the Fed.
Okay. All right. Yeah, we were just trying to figure because with this move, I would have expected the Japanese stock market to move a little higher, but that was down. So.
Yeah, and that was my point earlier today, Brett. I had brought up the fact that when you see Apple outperform, and it was up after hours 5-6% or whatever it was, you typically will see the Nikkei respond in kind, but that wasn't the case today. And then I looked at the yen, and it was somewhat weaker relative to the dollar. So with a declining stock market, declining yen, good Apple results, I was wondering if maybe there's something going on in Japan that we're not seeing. And when I see something like that, it at least gets me thinking, we should at least take a look and see and monitor it in the very least. So that's why I presented that question to Gavin.
Right. Yeah. No. I can't explain it. It's tracking right now with U.S. The futures. The Nikkei futures are tracking right now with the U.S. markets, so it's rallying.
Yeah, and
it was down.
Right. It was down during the Asian trading hours, and it was just a head scratcher. One of the things that I look at when I look at for anomalies and different trading opportunities, because that's what leads to different trade structures that you can find possible edges and whatnot. And that was just one of the things. Like, I see Apple up, you just expect the Nikkei to be up. Whoa, it's not. What's going on? So that's just how I was thinking of it, and it was. You guys are, part of my resource team to figure out what's going on in these markets, especially when I can't figure it out. So it may be, and I mentioned this earlier, and I think I confused Gavin, but it might be one of those things like you and I were talking a week ago when we had that huge build in crude oil, and I asked you, hey, what's going on in this? You're like, I don't know, there's something else going on.
Yeah.
And then we find out a week later what was probably really driving that, and it was the Venezuela news. So here we are. At least today, Brett, we can say that the EIA data and the response to it was actually representative in a case that you would actually expect it to,
Sure.
Slighter than
but maybe by coincidence.
Yeah, you never know with these numbers, right?
Yeah, right.
So, all right, gentlemen, unless there's anything else, I think we will table this until after the Fed releases. I do want to let the listeners know that it is must listen to radio or whatever you want to call this after the Fed, because Gavin and Chart will get on here and they break down what's going on. They lay out the different trading strategies and, hey, this is what I thought was going in, this is what's happening now, I'd like to see this, and they lay out all kinds of great stuff. So I encourage you to stick around post the Fed. It's way better than anything I've ever seen on TV. I can't wait to listen to it. So, fellas, I know I gave you a preview. I talked you guys up big time, and I know you won't let me down. But thank you so much for the preview, and be looking forward to the post-Fed analysis.
All right, talk to you guys soon.
All right, thanks a lot, guys.
He really is. He just looks
All right, so while I was talking to Gavin and Brett, TechT went out with a trade here in AMD, and this is a separate trade from Scalp Trader's trade. So Tech Trader is shorting AMD here. And just lost it. Bear with me. So AMD Tech Trader is or has shorted. It's currently trading 22.18, and he just notes that he's going to post this one little short and sweet trade. Looks like he is starting with a quarter-sized position and will look to add over time. But as for now, he is shorting AMD. And as most of you are well aware, Tech Trader doesn't go with stops. These are longer-term trades. He will adjust his analysis accordingly, but what he does is he goes in with smaller size, so he's starting with a quarter size position, and no stop on this one. And just getting back to what I was talking about when Chart Trader and Event Trader do their post-Fed analysis, and when I was a younger trader, I used to watch CNBC post-Fed and would listen to the commentators on TV, and they would give analysis, and that was all great, but they never really helped me trade. They never really helped me formulate any ideas. They just gave me some analysis that it just seemed like a bunch of talking head type stuff. And it was very frustrating, especially when you're trying to learn and get into the dynamics of trading and how to trade catalysts and events like this. I found it very, very frustrating. What I find very refreshing now is when these guys come on and start talking about it, and you can think about, or you can hear exactly what they're thinking about in real time. Hey, these are my ideas, these are my thoughts, this is how I'm responding to the activity, this is what he said, this is something maybe a little bit different than what we were expecting. This is, or maybe this is completely in line. So my thesis is working out perfectly. I'm getting ready to pull the trigger on a trade, whatever it may be. It's a lot more like that, and I appreciate that. And so I speak from the heart, and I'm going to endorse that and encourage everyone to pay attention to it. It should be, if nothing else, even if you don't make a single trade, educational. You'll learn a ton of stuff in a very short amount of time in real time. So definitely tune in post-Fed. It's good stuff.